Hi everyone, welcome to today's webinar on meeting the financial requirements of the application form. Hopefully you can all hear me okay. So thanks Mike. So I'm just going to do a bit of intro and housekeeping and a bit of an update and then hand over to my colleague David. So my name's Jess, I work in the Strategic Relationships team at Ofqual. Most likely I've met a few of you if you've registered on our portal and come through to our team. So our team is responsible for the engagement up to when you submit your application form. And my colleague David works in the finance and risk team, so he'll be talking you through the majority of the webinar today. So it's just for me to say hello, welcome. The webinar's being recorded. So we'll send out the recording with the slides once we've finalised those. There's the opportunity to submit questions throughout, so please use the question box for that, and we'll pick up questions at the end of the webinar. And just a quick update on EQA. So I know that there's organisations on the webinar that are partway through various parts of the application form, and some delivering endpoint assessment and some delivering other qualifications. So it's not just endpoint assessment organisations that we're talking to today, but I just wanted to give a very quick update on where we are with the EQA transition, just to say that we kicked off the transition process in August of bringing over standards initially that the Institute for Apprenticeships is responsible for through Open Awards. And we've done quite a number of engagements really, so we've done a few webinars and other resources to try and support organisations through, and like I said, you'll most likely have met with me or someone in the team if you're sort of partway through your application so far. So we're looking to bring over a number of standards in what we're calling year one of transition, and year one finishes in July. So we're sort of all hands on deck really, trying to support organisations as much as possible with getting a good quality application form in. The July deadline for EQA means that we need the applications in by April at the latest, because we have a 12-week turnaround submission deadline. So I just wanted to sort of reiterate that message, although I'm sure you're all aware, if you are part of that transition group, if there's anything we can do to support, if you've got any questions, then please get in touch, and our contact details will be at the bottom, will be at the end of this webinar, sorry. So I've just put some links to some of the other recent resources that we've published, and just a few things to highlight on there. So we've done an update to the guidance for the recognition criteria, which this webinar is sort of following on from. So we've clarified quite a lot of information in the guidance to try and make it more explicit for the type of evidence that we're looking for. So what we haven't done, what this is changing the goalposts. So we're not saying that, okay, the criteria is now changed. We're just trying to make it a bit more explicit, and especially with things like the financial requirements, it's a bit more, there's just more detail in there really, of the type of things that we're looking for, and that's what David will talk about today as well. I've put some links in there to a case study that we published recently with 4 organisations who have been through the process, so sort of what their experience was, and then links to some of our other videos that we've recently done, and we've got some future resources coming up. We'll be focusing on criteria D and also the governance and conflicts of interest aspects of the application form in the next couple of weeks and months. So that's it from me for now. So I'm going to pass over to David to talk you through the rest of the webinar, and we'll come to do questions at the end.
Thank you, Jess, and good afternoon, everybody. Could you move to the next slide, please? Okay, so the purpose of today is to run through the financial guidance in more detail. But before I do that, I'd just like to make a few opening comments to provide some context. Firstly, we absolutely recognise that not everybody who applies for Ofqual recognition is a finance expert, and therefore we want to be really clear and transparent about what we're looking for. Secondly, I will talk through a number of financial documents that we expect to see as part of an application, but I do realise that some of the aspects can be quite technical. So to help overcome this, I've included a worked example to help bring some of the theory to life. And finally, as we move through the presentation, you may be wondering why we need so much information. Well, it's because we get applications from a whole range of different organisations, including companies big and small, charities and sole traders. As a regulator, it's our duty to ensure that awarding organisations have sufficient resources to protect learners for the life cycle of the qualification. So we need you to supply enough information to provide us with assurance that you have a solid business plan and that you're financially secure. Today, I'm going to cover the key documents to include in the application. We'll have a look at each of the documents in turn. I'll provide an example using a hypothetical case study, and I'll try and give you some top tips along the way. In terms of outcomes, they are to increase understanding of the financial documents and level of detail we expect to see in an application, to increase knowledge of how and why we use these documents when reviewing an application, and to provide you with some tips and the hypothetical example to take away and consider. Next slide, please. So here's a list of the key documents that we expect to see as part of an application. As we move through the presentation today, I'll try and explain why it's helpful to see each of these documents and how they help us to form a rounded view of your application. Firstly, we'd like to see your published accounts. This helps us understand your track record, but don't worry if you're a new entity. I will come on to that later. Next up is your business plan and key assumptions. Letting us know your assumptions is really important as it helps to understand the numbers in your financial forecasts. Items 3 and 4 cover your profit and cash flow forecast and show us what you're planning to achieve over the next 3 years. And by the way, we don't expect you to make a profit from day one. It's quite normal to make losses in the early years as it takes time to become established. We understand that. Next up is the statement of funding, which helps us understand how your business is being financed. Finally, the sensitivity analysis provides us with a forecast range of outcomes taking account of uncertainty. With the ongoing pandemic, we appreciate the difficulty in producing an accurate forecast, so it helps if you can tell us the upsides and downsides that can affect your numbers and how your forecast might change under different scenarios. It's really important that you provide us with the documents on this slide. We see lots of applications where some of the key documents are missing, and sadly that means that we don't have enough information to reach an informed decision. Next slide, please. So now let's go through the key documents in more detail. First up, the published accounts. Simply put, if you're an established company or charity, we'd like to see your accounts for the past 3 years. We can sometimes find the information on Companies House or the Charities Commission, but there's often quite a time lag between the accounts being prepared and them appearing online, so please send them with your application. If you're a new entity, it does not preclude you from making an application. Just explain to us when the entity was formed and send us any accounts that are available. I do hope that's clear, but if you have any questions, there should be an opportunity to ask at the end. Next slide, please. For the business plan, a strong application would include some information on each of these 4 points. Firstly, tell us what market research you've done. For example, how big is the market sector? Who are the key players? Which customers are you targeting? What are your growth ambitions? And what is your unique selling point? Secondly, who are your key competitors? What is their market share? What are their strengths and weaknesses? And what are your strengths and weaknesses? How does your qualification or endpoint assessment differ from theirs? Thirdly, please explain your pricing strategy. How does it differ from the competition? Is it a like-for-like comparison, or are you offering something different? If you can provide us with a pricing comparison against similar qualifications or endpoint assessments, that really helps. Finally, it's useful if you can supply a forecast of the anticipated take-up of your qualification or EPA during the period of the plan. This needs to be realistic, taking account of the other 3 factors that I've just covered. Thinking carefully about this section will help give your application credibility. Let me give you an example. We sometimes get applications which claim the new entrant will gain 50% market share within 2 years, when we know that 90% of the market is dominated by 3 major players. Whilst it's good to be ambitious, the growth plan and business case has to be realistic, and applicants are encouraged to take account of the market dynamics. Next slide, please. The next step is to set out the key assumptions that will be used to build your business plan. If you can tell us the key assumptions, it helps us understand where the figures have come from and the basis of calculation. Unfortunately, we get a lot of applications that include figures but no assumptions. I can't emphasize enough that we need both, please. Otherwise, it can be a real struggle to make sense of the numbers. Let me give you an example. A revenue assumption might be that you are planning to complete 200 EPAs in the first year at a price of £300 each. This will generate an income of £60,000. Another 2 examples are given in the second bullet. This time they are cost related. The first one is that the business will be operated from home for the first 3 years to save on accommodation costs. The second one is that the directors have chosen not to take a salary for the first 2 years to enable the business to become established. We request that you provide assumptions for every revenue and cost line in the P&L so we can understand how you have arrived at the figures. The final point to draw your attention to relates to financial contingency. This is a pot of money built into your business plan that will provide cover against either cost overruns or unknown costs that have not been factored into the forecast. It's good practice to include contingency, as unfortunately none of us have a crystal ball when it comes to building a forecast, and we're all aware of how uncertain the economy is right now. Next slide, please. This slide sets out the level of detail required and the presentation format for the profit and loss forecast. We're very happy to see a summary table which shows the P&L for each year, but we'd also like to see a more detailed view which shows the monthly P&L for the first year with an annual total and the quarterly P&L for years 2 and 3 with annual totals. The reason we ask for this is because on a new venture, the revenue and profit can fluctuate a great deal from one month to the next, so it's helpful to see the monthly and quarterly figures as well as the annual totals. Next slide, please. This slide is an extract from the guidance and is essentially an explanation of how to construct the P&L. The revenue line is fairly straightforward, with the usual calculation being the number of certifications multiplied by price for each qualification or EPA. The cost line takes a similar approach, with each cost built from physical determinants. For example, salaries would be based on number of employees multiplied by individual salary costs. Accommodation would cover all building and facilities related costs. We request that you show each cost category in a different line on the P&L. This allows us to confirm that all possible costs have been included. Once the cost lines have been completed, it's simply a question of subtracting the total costs from the income to calculate the profit or loss for the period. I'm now going to move on to an example to illustrate how this might work in practice. We have invented a company called Newco Limited who wish to launch an EPA business, and they've applied to Ofqual for recognition. Although this example is based on EPAs, we have constructed it in such a way that would be equally applicable for qualifications. The example doesn't feature in the online guidance, but we thought it might be helpful to show you today. Next slide, please. So here we have a slide that shows the key assumptions provided by Newco Limited. This information can be used to build the P&L forecast. Under the income heading, you can see 3 assumptions that drive the price, the volume, and the timing of income. So let's unpack that. The price per EPA is £425, with £50 payable on registration and the balance due on completion. The forecast volume is 500 EPAs in year 1, rising by 10% per annum, and the time between registration and assessment is 3 months. On the cost side, it can be seen that the biggest cost is for assessors at £250 per day. Independent consultants are employed to carry out the assessments, and it takes 1 day per assessment plus a quarter of a day on top to do admin tasks and paperwork. The consultants are paid 1 month in arrears. The next biggest cost is employee salaries, which are £45,000 per annum. I'm not going to go through every single cost, but I would like to draw your attention to item 13, which is contingency. An allowance for contingency has been put in by NewCo based on 3% of direct costs. This will provide a pot of money to protect the profit against cost overruns or additional costs that were not foreseen at the time of building the forecast. I'm going to pause there for a moment, as I know there are quite a few facts and figures to take in. Let's now have a look at how this information can be used to build the profit and loss forecast. Next slide, please. First up, let me say I'm conscious that the P&L shown here is showing the annual figures when earlier on I asked for monthly figures. The annual figures are shown here purely for simplicity and to illustrate the principles. All of the numbers on this slide have been derived from the assumptions on the previous slide. Let's start at the top. Registrations are 500 in year 1 and then grow by circa 10% per annum. Income in year 1 is 212,500, which is calculated by multiplying 500 EPAs by the unit price of £425. I've put some notes on the right hand side that explain how the year 1 figures have been derived. Next, let's have a look at assessor fees in year 1. The 156,250 is calculated by working out the number of days. These are 500 for the assessments, plus 125 days for admin, giving a total of 625 days at £250 per day, and that comes to 156,250 that you can see in the P&L. The certificates are straightforward because we know that they cost £1 each, and it's simply a case of multiplying the cost by the volume. Let's move further down the P&L and pick a couple of examples in the indirect cost section. Employee salaries are 45,000 per annum, so nice and easy to slot in. Marketing is a cost of £5,000 in the first year only, so again an easy one to slot into the P&L forecast. Finally, let's have a look at the last item, which is contingency. If you recall from the assumption slide, this was based on 3% of direct costs, so the calculation year 1 would be the assessor fees plus certificates times 3%, which comes to 4,702 that you can see at the bottom of the P&L in the first column. Before we move away from this slide, I just want to draw your attention to the notes highlighting which of the costs are fixed and which are variable. There is a reason for doing this that will become clear as we move further into the presentation. The other thing to mention is that I believe this webinar is being recorded. I realise that the slides on screen are only there for just a few minutes and it may be hard to follow through all of the numbers and the information, but the recording should give you the opportunity to go over them again if you so wish. Next slide, please. So we're now moving on to another key document, which is the cash flow forecast. This one differs from the profit and loss as it simply shows how the bank account moves over the period. In terms of format, we request that you send us the first year on a monthly basis with an annual total and send us years 2 and 3 on a quarterly basis, again with annual totals. As you can imagine, the bank balance of a business can fluctuate a lot from one day to the next, with receipts coming in and payments going out at different times. The challenge here is that if we only asked for the end of year balances, it can mask the extent to which overdraft or funding facilities are required during the year. This will become clear as we move into the example. Next slide, please. So this slide is an extract from the guidance and provides an explanation on how to construct the cash flow statement. You start off with the opening balance, which in a new business would be 0. Next, you show the income line, which includes payments received from customers, loans from directors or investors, plus any other amounts paid into the bank. The next line shows all payments from the bank account, including payments to suppliers, contractors, salaries, taxes, and a whole host of other things such as cash withdrawn and direct debits. Item 1 plus 2 minus 3 gives you the closing cash balance. The closing balance at the end of the first month gives you the opening balance for month 2, and so on. To help bring this to life, let's now have a look at the cash flow forecast for NewCo Limited. Next slide, please. As with the P&L forecast for NewCo, the first thing you'll notice is that the example is shown in years rather than months. Similar to before, This is simply because I want to illustrate the principle without cluttering the slide with lots of columns of monthly figures, which make it much harder to follow. When submitting your application, we request that the figures are shown monthly for year 1 and quarterly for years 2 and 3 for the reasons previously explained. So here we have NewCo with an opening balance at the beginning of year 1 of 0. During the first year, they receive income of £204,250. There are some notes at the side explaining how this has been calculated. 500 EPAs of £50 on registration, plus 478 EPAs times £375 on completion. Taken together, this comes to £204,250. Now, the eagle-eyed amongst you will notice that the second part of the calculation shows a volume of 478 EPAs rather than 500. This is because there is a 3-month delay between registration and assessment, and therefore EPAs registered in the final few months of year 1 will not actually be assessed until the early months of year 2. It follows that in the cash flow statement you show income when it is received, which would be in year 2 rather than year 1. Let's move down to payments. In year 1, there are payments of £199,777 to cover the costs of running the business. This includes most of the assessor costs, but remember that the consultants are paid 1 month in arrears, so they will get paid at the start of year 2 for assessments completed in the final month of year 1. By subtracting the payments of £199,777 from the income of £204,250, leaves a cash balance of £4473 at the end of year 1. This is then carried forward to the opening balance of year 2. At the bottom of the slide, you can see a line called Peak Cash Requirement. This shows the maximum amount that NewCo Limited requires funding during the year. You can see the overdraft figure in red increases to 14,641 in year 2, which is very different to the closing cash balance for year 2, which is a positive 7,448. So the 14,641 is their worst month of the year. This is why it's so important for us to see the monthly figures. They can fluctuate a great deal, and the year-end figure is not a good indicator of the level of funding that may be required at certain points of the year. In this example, the numbers are quite small, but we receive applications where the level of funding required in the early years can be several £100,000. That level of financing needs to be flagged in advance and appropriate levels of funding secured. Otherwise, there could be a risk to learners if the business suddenly runs out of cash. I'll just pause there for a moment because, again, there's quite a lot to take in. Okay, let's move to the next slide, please. This is a document which sets out how the business will be funded. We request that you send us details of the funding you have obtained plus the associated terms and conditions. Where loans have been taken out, we expect to see the amount of the loan and conditions which control the repayment. We also need you to send us details of interest expectations and security for the lender. Let me give you an example. If a significant amount has been borrowed from an investor that is repayable after 2 years, but the life cycle of the qualification is 3 years, we may be concerned that learners could be put at risk if the amount borrowed needs to be repaid before their qualification is complete. Next slide, please. So we're often asked to explain what we mean by sensitivity analysis. This is a process that is applied to the financial forecasts. The aim is to establish the potential circumstances that might divert the forecast from its proposed direction of travel. When sending us forecasts, we expect you to provide a sensitivity analysis that covers 3 scenarios. These are the base case, the worst case, and the best case. I will now explain each of these scenarios in more detail. Next slide, please. So the base case is simply the P&L forecast that we have already covered. In other words, this is what you expect to happen. The best case involves looking at the potential upsides. What could happen if learner numbers increased beyond those anticipated in the plan? Or if costs reduced compared with the plan? For example, this could be achieved through greater efficiency or improved productivity. When constructing your forecast, please consider the key variables that will affect your plan and how sensitive your forecasts are to changes in those key variables. The worst case involves looking at the potential downsides and could include the effects of a pandemic or a global event. It could also include things like a reduction in learner numbers compared with those anticipated in your plan, or a change in legislation that increases your cost base. Similar to above, please consider the variables that will affect your plan and how sensitive your forecasts are to changes in those variables. In summary, we'd like you to provide a reasonable worst case and best case forecast as well as the expected case, so we have visibility of the potential range of outcomes. A lot can happen over 3 years, and it's helpful to see the potential upsides and downsides and what could trigger those movements away from the base forecast. Now, let's bring this to life by taking a look at the sensitivity analysis for NewCo Limited. Next slide, please. In this slide, the middle section shows the base case P&L forecast that we looked at earlier. To the left, we show you what could happen if EPA volumes decline by 20%. You can see that revenue is down and there are significant losses in each of the 3 years. To the right, we show what could happen if EPA volumes increase by 20%. You can see that under this scenario, revenue increases and NewCo generates a profit in each of the 3 years. The other point to note on this slide are the rows shaded in yellow. These represent fixed costs that are unaffected in the short term by changes in volume of EPAs and revenue. It's important to identify which costs are fixed and which are variable when doing the sensitivity analysis. This is really a simple example to highlight the principle of sensitivity analysis and how relatively small changes to key assumptions can alter the forecasts in terms of upsides and downsides. However, it's not just the P&L that would be affected by a change in EPA volumes. Let's now have a look at how the cash forecast for NewCo is impacted. Next slide, please. As before, the middle column shows the cash forecast that we created earlier. To the left, we see what would happen if EPA volumes decline by 20%, and straight away you can see that the closing balance becomes negative in every year. It can also be seen that the peak cash requirement almost doubles in year 2 and trebles in year 3. Under this scenario, funding would be required of more than 26,000 in year 2 and more than 34,000 in year 3. On a positive note, under the best case scenario, the closing cash balance is significantly better than the base case in every year. The peak cash requirement reduces to 6,472 in year 1 and 4,376 in year 2. By year 3, in fact, there is no funding requirement at all. Hopefully, this example illustrates how a relatively small change in a key assumption, in this case EPA volumes, has a significant effect on cash flow and funding requirements. Next slide, please. So whilst we do not ask for a balance sheet forecast in your initial application, we may ask for one at a later stage. So with this in mind, and for completeness, I thought it would be helpful to show you what the balance sheet for NewCo would look like. The balance sheet is essentially a statement of assets and liabilities on a given day. If you were to construct another balance sheet a week later, all the numbers would be different. This is because income would be received from customers and payments made to suppliers, thus affecting the bank account and debtor and creditor balances. In the case of NewCo, you can see that in years 1 and 2, net assets were negative and then turned positive in year 3 as the business and profits grow. You can also see that the cash line is consistent with the cash flow forecast that we produced earlier, and the P&L line reconciles with the P&L forecast that we produced earlier. As I say, we don't ask for a balance sheet with your initial application, but we may ask for one later in the process, so I hope this helps to show you what we'd be looking for. Next slide, please. So we've just dived into the detail, but let's do a quick reminder of the key documents. They are the published accounts showing us what you've achieved in the past. If you don't have 3 years trading history, just let us know. The business plan and key assumptions. This covers your market research and modelling assumptions. The P&L forecast is a forward-looking view using the key assumptions. The cash flow forecast shows us how your bank account is expected to move over the period of the forecast. It helps us to understand the level of funding required. The statement of funding explains how the business will be financed and what are the terms and conditions, etc. And the sensitivity analysis, this provides us with a range of forecast outcomes from the best case to the worst case, and also tells us where in that range you expect to land. Next slide, please. So I thought I'd finish off by giving you some top tips from the applications that we've reviewed. First one would be keep it simple. The focus should be on explaining what you are proposing to offer and how you will achieve your goals. Tell your story in a compelling way. Start off with your key assumptions before doing the financial forecasts. Set out the assumptions clearly. Make sure your application is consistent. Do not quote figures without indicating where they have come from. Make sure you cross-reference. Remember to provide the key documents as per the guidance, otherwise it makes it difficult for us to reach an informed decision. Identify your fixed and variable costs. And when doing the sensitivity analysis, test your financial model to determine the variables that have the biggest impact on your business plan and tell us what they are. Then you can flex the model and work out the best case and the worst case forecast. Finally, proofread your application before sending it in. So now I've almost reached the end of the presentation. I do hope you found it useful today and that it provides clarity on the key documents. We realise there is a lot of work in putting them together, but not only does it help your application, it also ensures that you are prepared for success. From an Ofqual point of view, it means that we'll have all the information required to reach an informed decision and can focus on the strength of your application. With that, I wish you all the very best of luck